While Wall Street chases quarterly earnings and daily stock ticks, one man built a $100 billion fortune by doing the exact opposite. This is the story of Warren Buffett and the long-term philosophy that changed investing forever. August 30th, 1930, Omaha, Nebraska. Warren Edward Buffett is born during the worst economic collapse in modern history. His father, Howard, loses his job as a stockbroker just months after Warren's birth. But this crisis plants a seed. Young Warren watches his father rebuild, opening his own brokerage firm. At age 6, Warren buys his first stock, 6 shares of Cities Service, preferred at $38 each. The stock drops to $27. He panics and sells at $40, making a small profit. At age 11, he reads 1,000 Ways to Make $1,000. By 13, he files his first tax return. By 15, he's earning more than his teachers. But the real transformation happens at Columbia Business School, where he meets Benjamin Graham, the father of value investing. Graham teaches him a radical idea. Stocks aren't lottery tickets, they're pieces of businesses. And if you buy quality businesses at prices below their true value, time becomes your greatest ally. 1962. Buffett starts buying shares of Berkshire Hathaway, a struggling textile company. It's a terrible business, and Warren knows it, but the price is too low to resist. By 1965, he takes control. Then he does something unprecedented. He abandons textiles and turns Berkshire into a holding company, a vehicle to acquire great businesses at fair prices. The results: since 1965, Berkshire stock has grown at nearly 20% annually, crushing the S&P 500's 10%. A $10,000 investment in 1965 would be worth over $300 million today. Rule 1. Invest in what you understand. Buffett calls it his circle of competence. During the dot-com bubble, everyone told him he was finished. He refused to buy tech stocks he didn't understand. When the bubble burst, those critics lost fortunes. Buffett's wealth barely moved. He was proven right, not by being smarter, but by being honest about what he didn't know. Rule 2. Buy quality, not price. His most famous quote: "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." In 1988, he buys $1 billion of Coca-Cola stock, not because it's cheap but because it's an unstoppable global brand with pricing power. That investment is now worth over $25 billion. Rule 3. Time is your friend. Buffett's favorite holding period: forever. He doesn't trade. He owns. His portfolio turnover is under 5% annually, while the average fund turns over 80%. This isn't laziness. It's strategy. Every trade costs money. Every sale triggers taxes. Time and compound interest do the heavy lifting if you let them. Rule 4. Be fearful when others are greedy, and greedy when others are fearful. 2008. The financial system is collapsing. Banks are failing. Panic is everywhere. While others sell, Buffett invests $5 billion in Goldman Sachs, another $5 billion in Bank of America. These investments return billions in profit, not because he predicted recovery but because he acted when prices were irrational. Rule 5. Focus on businesses, not markets. Buffett doesn't care what the market does tomorrow. He cares if a business generates cash, has competitive advantages, and is run by honest managers. He asks, will people still drink Coke in 20 years? Will they still need insurance? If yes, short-term price drops are opportunities, not disasters. Today's market moves faster than ever. Algorithm trading. 24-hour news cycle screaming about every tick. The average holding period for stocks has dropped from 8 years in the 1960s to just 10 months today. Studies show that investors who check their portfolios daily underperform those who check quarterly by 2 to 3% annually. The more you react, the less you earn. Meanwhile, Buffett sits in his modest office in Omaha, reads annual reports, and waits. He's not smarter, he's more patient. And in investing, patience is a competitive advantage most people can't access because they won't wait. Today, at 95 years old, Warren Buffett's fortune is worth over $130 billion. But his real legacy isn't the money, it's the philosophy. He proved that you don't need to be the smartest person in the room. You don't need insider information or complex algorithms. You need discipline, you need patience, and you need to see investing, not as gambling, but as ownership. When everyone else is thinking quarters, think decades. When others panic, stay rational. When markets scream, tune them out. As he says, the stock market is a device for transferring money from the impatient to the patient. The long-term philosophy isn't sexy, It won't make you rich overnight, but over decades, it's undefeated. If this story changed how you think about investing, leave a comment below and don't forget to subscribe. And remember, time in the market beats timing the market every single time.